Hello, welcome to Institutional Dialogue. I'm Amos, Chief Business Officer at DigiFT. In this series, we sit down with leading voices in institutional finance and digital asset to talk about how the capital markets are evolving and how we can help allocators navigate it. If you've been following the capital markets for the past, I would say 3 to 6 months, you would have noticed one word comes out a lot in the conversation with be it central bankers, economists, or financial analysts, and that would be the word uncertainty. And where we are seeing is there's actually an interesting shift in terms of institutional portfolio amidst this uncertain environment where cash is no longer just a place to park capital where you wait for clarity or opportunities, but instead it's becoming a more intentional and thoughtful approach, a strategic position to hold. So today we're really excited to have Rob Sabatino, Global Head of Money Market Portfolio Management at UBS Asset Management, join us. UBS Asset Management is one of the leading voices on liquidity and short-term fixed income. So I'm personally looking forward to our conversation today. Thank you, Rob, for making time.
Thank you, Amos. Appreciate the invitation to be here.
Look, Rob, before we deep dive, why don't we do a snapshot of the liquidity and short-term fixed income landscape today?
Sure. Yeah, I think you highlighted that these are interesting times. From a historic perspective, we're still in a very attractive yield environment, right? For those who could remember the zero interest rate environment, those are long, distant past memories. So investors are in cash because not only do they want the safety and liquidity and security that we provide in liquidity management space, but they also like the attractive yield.
Right.
So we feel that some investors have so much cash that they're in a situation where they're adding to their positions when we enter volatile periods.
Right.
Other investors are keeping the same amount that they had prior to some of the volatility we've seen. But the factor that continues to be mentioned is just the need for cash management, professionally managed cash management. Many of our clients have been doing it in-house, and they realize that they don't have the expertise, they don't have the credit research and all the bells and whistles that an asset manager provides.
Right. I guess on short-term fixed income specifically, are you seeing any compelling opportunities at this point?
Well, I think it goes back to individual clients' needs, right? We have clients that know that they're going to need their money immediately within the next 3 months. We have other clients that are not so certain, so they want to keep it as liquid as possible. And those type of clients tend to be in a commingled vehicle, such as a money market fund.
Right.
For clients that have a bucket of cash that they're not going to need for maybe a year's time or even out to 2 or 3 years, they look to segment and they go into reserve or maybe strategic. So in the reserve space, we introduce products that are slightly out of money market space. We call them ultra short or short duration. Mm-hmm. For clients that have a higher yield bogey and they feel that the cash isn't going to be drawn down for many years, they even go into lower credit quality, still staying in the short duration space, so 2 years and in, but they might introduce some high yields into their portfolio or even emerging market debt.
I know this may be not applicable across the board, but I guess from an investor's perspective, they tend to like to know from a duration, if you're like just looking at duration, is there a sweet spot that I should be focused on or thinking about?
Yeah, I think that goes back to the individual client's needs,
yes.
Right? So most of them feel comfortable 2 years and in when they're allocating to more of their reserve or strategic balance.
Right.
And that's where I mentioned going down on credit quality, going a little bit further in duration. But for the operating balance, that typically is 3 months and in.
3 months and in. And I guess based on what you have seen across your institutional investors or allocators that you worked with, are there some common missteps or mistakes that you think is worth sharing with the audience today?
Yeah, I think what we see repeatedly is investors that may not have a really good sense of their liquidity needs. And so if they really don't, sometimes it's out of their control, right? The drawdowns might occur. They don't have a heads up because of how they're structured in their organization. Other times they really just haven't done the analysis.
Right.
And so if you don't know what your needs are, you tend to be ultra conservative and keep it all in daily T+1 liquidity of a money market fund. And so they miss the opportunity to move out duration and down the credit quality.
Got you. So I guess it still comes back to the fundamental, what is the core requirements and use case for each of these investors.
Correct.
Right.
Yeah.
And I guess circling back to DigiFT, given that we sit at the intersection of institutional finance and on-chain infrastructure, how do you think about tokenization and technology and its influence on liquidity management, where we are right now in the space?
Yeah, it's very exciting. When you look at liquidity management, the fact is it's a very mature market, yet we are at the epicenter of innovation, right? Talking about tokenized products and creating opportunities and use cases that we're seeing resonate with a lot of our institutional investors.
From a readiness perspective, let's say focusing on just tokenized money market fund as an example, how ready do you think are these institutional allocators when it comes to investing into a tokenized version of the money market fund?
I think it depends on the institution. The market's very excited about it.
Yeah.
There have been numerous launches of different products. We haven't seen a rapid uptake. I think some of that has to do with the individual institutions and having to have their regulation either from their regulators or internally, creating some sort of guardrails, if you will,
right,
and deciding how they could best employ this new technology.
Right. You talked about regulator earlier. Just to pick your brain, given that you cover global, how far do you think we are in the journey in terms of regulatory clarity around tokenization as a toolkit for traditional finance?
Well, I think we've seen out of the US some movement there and some regulation around stablecoins and what should be in a stablecoin, what shouldn't. So I think that's the beginning of the regulatory journey, if you will. But I feel that we have a long way to go. I don't see the standardization that we have, let's say, in the money market space, the traditional space. Surprisingly, even though blockchain's been around for so long, we haven't seen it on the settlement side as much, right? We're talking about the individual funds being tokenized, but the process within a traditional money market fund of settling the securities still is done the traditional way.
Right.
And when I think about the efficiency, both from a time of settlement as well as costs, you would think that the custodian banks would have moved already on that front, but a little slow to change the plumbing, if you will.
Got you. I guess from our perspective, one of the more interesting conversations that we have seen around tokenized money market fund is for it as in terms of use case, I guess, is for it to be a collateral, be it collateral for borrowing on chain or for margin trading at some of the centralized exchanges that we worked with. For UMIN specifically, we deployed a use case with Bybit and KuCoin, where traders can use that tokenized money market fund as a collateral for margin trading. So from their perspective, it's not just cash and liquidity management. There's also unlock in terms of value for cash that are sitting there, where it may not be generating any yield on chain. So I think from our perspective, it's exciting. I guess coming back to you, if you looked at the next 3 to 6 months, what would you say to institutional allocators? What should they be thinking about? What should they be focused on in terms of opportunity and risk?
Yeah, I think you highlighted one of the best use cases, right? The fact that you could pledge these instruments and you could move them very quickly using technology. But at the end of the day, the underlying investment is in a liquidity vehicle. And I think for those investors that are not used to the space, they may not appreciate the amount of work in producing a portfolio that has stability of principal as well as liquidity. Right. We have many investors who are new to the space who think, oh, a liquidity vehicle, they're all the same. But we know that, in different regulatory regimes, there are different rules. Each manager has internal rules. Some are willing to take risk that, frankly, we at UBS don't think is warranted in a money market fund, right? You go back to the principles of liquidity management, and it's preservation of capital,
Right.
liquidity, and the third is competitive yield. And we take that very seriously with our portfolio management team, our research staff, our risk folks, to really try to mitigate risk within our liquidity portfolios, not just the underlying credit risk, but taking it a step further, we look at headline risk.
Yeah.
We know many of our investors, when they're thinking about cash, they don't want to have to worry. They don't want to be up at night. They don't want to get questions from within their organization
Right.
about the risk they're taking. So we feel very strongly that we shouldn't be using derivatives in a money market liquidity portfolio. We shouldn't be introducing FX risk and hedging.
Right.
We only invest in the local currency of that money market vehicle. And we also feel that the structure is very important. Right? How much daily liquidity you have, how concentrated your investor base is.
Yeah.
All of those things result in creating a fund that is more resilient.
Right.
And we have periods of market volatility, limited liquidity in the market, regardless of the security. The bid-ask spread might widen. And we never really want to be a forced seller. So we build our portfolios to be able to withstand the uncertainty, both from an investor needs, the redemption flow we may not have a heads up on, as well as market illiquidity.
Yeah, so I think that's quite a interesting and quite a valid point that I think the audience should take note of. We started the conversation talking about uncertainty in the market and volatility, but truly at the end of the day, to cut through the noise, you need to focus on the first principles and be disciplined in terms of the execution. And that's where we see, truly the value that UBS brings to the table in this tokenized money market fund that we are distributing. I guess just wrapping up, for the audience today, what if you want them to take away 1 to 2 things from this conversation, what would that be?
Yeah, I think the importance of understanding liquidity in the market. And we have many investors that come to us who manage their own liquidity needs. And a lot of times they have excess concentration risk. They also don't have as much liquidity as they think.
Right.
When they're building a portfolio of laddered deposits, they feel that it's ample, but it really doesn't meet the true daily liquidity test that a money market fund has. So appreciating the importance of professional management and the structure that we provide and being an extension of their treasury team.
Right. Well, Rob, thank you for joining us today. That was really informative. I'm sure our audience would have benefited significantly from this conversation.
Thank you for having me.
And to our audience, thank you for joining us today. If you enjoyed this conversation, please subscribe and share this with your colleagues, and we'll see you at the next episode. Thank you.